This is Chapter 8. Our focus is inventory. There are 4 parts. Part 1 covers adjustments based on year-end physical inventory, describes the difference between perpetual and periodic journal entries, and discusses trade and purchase discounts. So the focus here is journal entries. The first thing we're going to look at is what do you include in ending inventory once you've done a physical account and you have some items that are in transit, whether you bought them or sold them. Okay, here's our example. We have 210. We did a physical count. It didn't matter whether it's perpetual or periodic. This can happen. And so the first thing we have is goods are shipped to Quoc FOB destination on December 20th, 2018, but they didn't get them until January 4th. Now, here's the rule. If it's FOB destination, ownership does not transfer until it's received. So, in our example, since it was not received by the person who bought it, which is the person whose inventory we're looking at, we do not include it in the count. Next, we had goods shipped to Quoc FOB shipping point on December 28th, but they weren't received till January 5th, which means they would not have been included in the count, but since it's FOB shipping point, it means ownership transferred to the buyers on December 28th. So therefore, we would have to include that one. Next, goods shipped from Quoc to a customer FOB destination on January 27th were received by the customer on January 3rd. What that means is that the Quoc still owns it until the 3rd. So we must include that in our physical inventory. All right, the next thing that happened is they shipped goods to a customer FOB destination on December 26th, but they were received by the customer on December 30th, which means that it should not be in their inventory. Because even though it's FOB destination, they received it by year end. Now last, we have goods shipped from Quoc to FOB shipping point on December 28th, received by the customer on January 4th. The sale price was $34,000. So what this means is it would not have been included in their count, but since it's FOB shipping point, they transfer ownership when it leaves their dock, so this would not be included. So now we have a total adjusted ending inventory of $267. So what you have to think about again is when does ownership transfer, whether you're buying or selling, determines what is in inventory. Next, we're going to look at the difference between perpetual and periodic. This is a nice little summary, but the big difference is under perpetual, we're continually keeping track of our cost of goods sold, so we can measure at any point in time what our gross profit is. It is more expensive because you're going to have to use barcoding because you have to have a method of keeping track of inventory quantities and costs at all times. Periodic is a lot easier, but every time you make a sale, you cannot book cost of goods sold because you have to do a physical inventory. Usually this is at the end of the month, and this takes a lot of time, and therefore, unless you do a physical inventory, you can't do financials or determine your gross profit. However, it is less costly. So, but you have to constantly monitor inventory quantities only, but you have to keep track of them going out because you have no way of knowing in the system what you have on the shelves. This is usually used by small stores. Now, when we talk about discounts, there's 2 types, trade and purchase discounts. Trade discounts are ignored. An example would be a company has a list price of $100, but if you buy a certain quantity, you can get them for $50. You would book them at $50 if you bought the large quantity, so it's whatever you paid for it. The reason people do this in their catalogs is because they hate to want to keep reprinting their catalog every time they make a sale or somebody comes in with some special deal. Purchase discounts, however, we do have to take into account for, and there are 2 methods we can use. The gross method, we record the total purchase price and use a discount not taken as part of the cost of inventory. Net method, We record the purchase net of the discount, and the discount is viewed as compensation to the seller for financing, so therefore if it's not taken, it's treated as interest expense. So now what I'll do is walk you through the journal entries under the periodic system under the gross and net method. All right, we have an example. 1,000 units were purchased. They have a list price of 10, but we pay 6 because of the volume. That means that's what we're going to record is the $6. The terms are 5% in 10 days, net 30, and they use the periodic system. So let's take a look at what this looks like. When they purchase it, it's going to be, since we're using the periodic system, it goes to purchases at the gross amount. If they paid within terms, it would become part of inventory as part of purchase discounts. However, if they paid after terms, they would just record the whole amount. Now, the net method, we're going to take out the discount. And if it's paid within terms, we're just going to book the accounts payable and the cash. If it's paid outside of terms, we're going to book interest expense of $300. So that's the difference between the two methods when we buy. Now, perpetual inventory system. Again, we are continually adjusting the inventory account. Each time there's a change in inventory caused by, we are going to add purchases minus sales minus return of merchant by the company plus freight in, never freight out. Freight out is a selling expense. Plus return by customers assuming the item is still good for sale, and minus any purchase discounts. We are continually adjusting cost of goods sold account each time goods are sold or returned by the customer. So let's now work through some entries under the perpetual system. So a company had beginning inventory of 20,000. They bought inventory 2% off in 10 days, net 30. So in this case, we're using the net method. So we have to book the inventory minus the purchase discount, and that we book it at 98. And again, it goes to inventory. We paid freight, which goes to inventory. We return goods. Remember, when you return the goods, you have to back out that discount. Okay? And paid for balance of goods purchased after terms, we would go accounts payable, 98, minus the 49, since they paid after terms, so that of the returns, so the accounts payable is going to be 93,100. The interest expense is 1,900 because we didn't get that portion of the discount, and the cash would be 95,000. So this is what it looks like. Now, what happens when we sell the goods? It's going to be accounts receivable for 110, cost of goods sold for 80. Now, how do we determine ending inventory? This is what would have happened, the transactions in our account called inventory. We would show beginning plus purchases plus freight in minus returns or purchase returns. Total cost of goods available for sale is 114,400 minus cost of goods sold. So ending inventory would be 34,100. All of these would have been adjustments again to the inventory account. Now again, since we use the net method, we don't have that the benefit of the early payment. Now, periodic. We adjust the inventory account and cost of goods sold only at the end of each reporting period. Record purchases, use new accounts called purchases, purchase returns, purchase discounts, and freight in. These are temporary accounts. And we're going to adjust these every time we do a physical inventory. You cannot determine cost of goods sold until you do a physical inventory, and cost of goods sold is going to be an adjustment of the account, the temporary accounts, and I'll show you how that's done. Now again, this is what we've already done under the perpetual. And again, since we're doing perpetual, we can book cost of goods sold at the point of sale. Now under periodic, when we buy the goods, it goes to an account called purchases. When we pay for the freight, it goes to an account called freight in. When we return, we're going to back it out, net amount, since we're using the net amount method. When we pay it, it's just going to reduce accounts payable. It's actually the same entry as it is for perpetual. Now, when we sold goods for $110,000, all we can do is book the accounts receivable and book the sale, because what do we need to do? We need to do a physical inventory. So we go in and do a physical inventory, and we say our ending inventory is 34.3. Now what we have to do is determine cost of goods sold for our journal entry. So we're going to take beginning inventory plus purchases plus freight in minus returns gives us total cost of goods available for sale of $114,400. We're going to back out our inventory, and this gives us our cost of goods sold, and now we can do our journal entry. But what we also have to do is clear out our temporary accounts and adjust the ending inventory to 34.3. So cost of goods sold will be booked at $80,100. Inventory, our beginning inventory, will now be 34.3. Purchase returns will be zeroed out. Freight in will be zeroed out. Purchases will be zeroed out. And the beginning balance will be zeroed out. And that would be our journal entry. So a lot more journal entries when you use periodic. And that concludes part 1 of this presentation.